most of the activity we see in options right now is not for insurance. It's to bet on further upside. It's to perpetuate FOMO. It's to beget momentum. And it is not for hedging. It is really historically out of whack with what we would expect from all that empirical data that I looked at Princeton.
This is a special treat. Damian Sassower's wheelhouse. Mr. Sassower, take over the interview and make it smarter.
Well, Amy, I'm going to try and throw you a curveball here because I'm an emerging market guy, but an emerging market fixed income guy. So I'm going to look at emerging market equities here. I'm going to look at that big MSCI EM ETF run by BlackRock, and I'm going to look at the skew, all the call buying, all the bullish call buying that's been going on.
Momentum.
I mean, should we look through that and see that as a signal that perhaps, EM equities are going to go up from here? I mean, how do you look at skew? How do you look at the options markets on some of these large ETFs?
I think that's a really interesting question. I will tell you, I was actually in the UK a few weeks ago, and I just asked investors that kind of point blank, why is this call skew bid? It's actually bid in the other ETFs proxies for China, like FXI as well. And what we have heard from investors is, a few years ago, the trade of the moment was China rebound. It did not happen. Folks are a little bit worried that it may never happen, but the right tail is that it could happen.
Yes.
So a lot of this bid is actually a right tail hedge to the idea that we have bottomed. So I will say investors don't think that that is true, but that's certainly they're worried and they're not positioned for it yet.
I mean, I just have to cut you to our audience. You know how valuable that information is. The fact that basically, the China rebound trade, which, people have poo-pooed now. It's gone. It's forever gone. It's never going to come back. Just to play for that tail risk, makes a lot of sense. And to do it with vol at these levels, Amy, I agree completely. But, we were talking a little bit earlier about which volatility market we should be most focused on. Is it equity vol? Is it rate vol? Is it FX vol? What do you think?
So, of course, I'm going to be a little biased because I'm an equity vol person. But, outside of rates vol, all the vols kind of look similar. It's not like you're getting anything different other than the rates vol universe when you think cross asset. Equity vol, especially on the left tail, is incredibly inexpensive. But there's only so many times a girl can cry wolf, right? People don't want to hear it. They don't want to be positioned for it. They're far more concerned about the reach.
I was smarter in September of 1998 than I was in July of 1998. And it had to do with the dreaded L word, Amy, Wu Silverman, leverage. And, we didn't know what 15 to 1 or 22 to 1 until Myron Scholes explained it to us. What's the shadow right now in the market? You can't tell me. This is a free lunch. Is it like a blatant leverage, an implied leverage, or is it some other mystery I can't see?
So, Tom, I'll tell you the hottest topic to debate right now in equities is just the idea of if all the short volatility trades that we're seeing from folks selling calls, from harvesting, volatility risk premium, if this some way implodes the way we saw from 2018's Volmageddon. And, this is going to sound a little party pooper, but we don't think so, is the short answer. The kind of leverage in the system and the kind of trades that are going on, especially if you include the delta from the stock, is just dissimilar. It doesn't mean it cannot end. It's just not going to end necessarily in the same way. And I think that most volatility people would say that that is so, just given the nature of these trades.
Volmageddon. Look, for me, Amy, it's these buy right strategies and, these ETFs that are, trying to, get investors to, take advantage of that, of the premium.
Let's explain that to mere mortals listening, okay? Because this is a third rail for me. You buy the asset and you write the option against it to bring in a further income.
That's correct.
Until it works. Continue.
Exactly right. And now they have ETFs that are supposed to mimic that type of a strategy. Amy, how convinced are you that that ETF is going to deliver that type of performance at the end of the day?
So it's interesting. In some ways, this is like one of the most bread and butter trades of the derivatives world. It's kind of for a market where you don't see substantial upside. It's another way to get a little yield in a world where, rates don't give you that much yield. What I think is interesting about the success of these products is we actually had a relatively high rate yield environment, especially compared to history. Right. And then we've obviously had a market where certain stocks have absolutely ripped. So it works for some things. It doesn't necessarily work for others. It really depends on your underlier, right? It depends where that delta is coming from. Wow. But look, these are actually very bread and butter better trades where if you have the underlying and you get stopped out, it's not really that big a deal.
We're going to go Matthew here right now, folks. Stay with me here. We're going to do the conceit of a global Wall Street audience again with Amy Wu Silverman of RBC Capital Markets. Amy Wu, if I have an implied log normal distribution where I go up on a slope that's not as harsh as the slope that I go down, and if I have all the different leverage, the bets, and the setups within the system, where we are right now, I have parabolic charts. I got a squared function that's incalculable in Nvidia, but particularly in something away from you, in Bitcoin. Do they track a log normal distribution on the way down? If Bitcoin goes down, if Nvidia goes down, in what way do they go down?
So look, Tom, this goes back to what is it, an escalator up and then an elevator down, right? And I do think, this is part of the concern. That's part of the concern with what I mentioned with these short vol trades. The really interesting thing I would say about Bitcoin, because, you can't dabble in volatility without dabbling in crypto a little, is that this has historically been a risk asset correlation that's actually been positive, even though it's been made out not to be. However, we are actually seeing that correlation decline. So if you look 3 years ago, the correlation between just the simple equity market and Bitcoin was fairly positive, and it is still positive, to be clear, but it's actually come in a lot. And so it may actually begin to be behaving in the inflation hedge / equity hedge that it was purported to be in the beginning.
That's a critical statement.
Yeah, no, I mean,
for global Wall Street, what she just said is a huge deal.
And now I'm going to just ask the dumbest question, Amy. I mean, I'm looking at put call open interest on Nvidia. I mean, wow. I mean, talk to us about what your takeaway is from the options market on what is arguably the highest of high-flying stocks in the U.S. equity market.
So I'll tell you, I think there's peak FOMO when derivative strategists sit back and say, wish I had an Nvidia call. That's kind of how I felt after watching this thing.
Wow.
What's interesting is after the recent sell-off in Nvidia, its first one after a while, those calls didn't move. So meaning people weren't worried about the momentum. They went right back into it. And those call skews are still at historic level, still saying incredibly bullish things. March 18th, there is an AI conference with Nvidia that a lot of folks that we speak to are looking to play.